It's great to see you again. So certainly no shortage of news that we are expecting this week. Rachelle just mentioned the warning from Apple, although it looks like the equity market able to kind of shrug that off, at least for now. What's your assessment of the gains that we're seeing today?
I think there is an undercurrent here of some of the earnings picture, some companies that have done better, some that have done worse. But I think what's driving the market today, same thing as last week, same thing as the rest of October, and that is this step down by global central banks. We didn't hear it from the Fed, but we heard it from the Reserve Bank of Australia, from Canada, from the UK, Norway. Many major central banks have begun to step down from 50 to 25 or 75 to 50 basis points, depending on the bank, and indicating that they might be nearing the end of the rate hike cycle. The UK even went out as far as to say the market was wrong, that they weren't going to hike as much as the market had expected. And I think if you can see it in the market, particularly today, some of those more liquidity-driven stocks are up the most today, really showing that I think it is about this idea that maybe we're getting near the end of this liquidity drain, not this month or next month, perhaps early next year, and the markets are beginning to price in that Santa pause rally from the world central banks.
And Jeffrey, a lot of people were wondering when the central banks were going to start moving more in concert. We've seen that now, but as the markets are digesting the information that they're getting now from these rate hikes, is there anything you think they're missing in the picture at the moment?
Well, one of the reasons why many of these central banks are stepping down is not because they've successfully tamed inflation. It's because economic growth is weakening. I think we were all surprised by how strong third quarter GDP was, not just here in the U.S., but in Europe, in Asia as well. And I think actually during the third quarter, the recession probably began. Maybe the global recession began in September. We had the PMI drop below 50. That's of course, a very important indicator for the manufacturing sector. We had the OECD's leading economic indicator for the globe dip down below 99. We've never dropped below 99 and not been at the start of a recession. So a lot of these key indicators are pointing to a recession underway, and I'm afraid that's the reason. So we might expect further downside risk to earnings estimates and maybe economic estimates as we look out over the next couple of quarters, even if that coincides with an end to some of these rate hikes.
Hey, Jeffrey, that's interesting because Goldman out this morning cutting its S&P earnings growth through 2024, naming off a number of headwinds that will potentially weigh on profit margins. But they're expecting 0% growth in 2023, followed by modest growth the following year. You mentioned the fact that you might see the need to do this. I guess, one, what would indicate to you that you need to lower your expectations? And I guess, what do you see that potentially looking like?
Well, we've already seen this pullback in manufacturing activity on huge levels of inventory, really across the chain. This isn't just retailers. I know, as we get into the holiday season, we hear about some of the big chain retailers being stuffed with a lot of inventory, but it's true across the manufacturing sector as well. Really, all the way through that supply chain for goods, we are seeing inventories absolutely stocked. That means lower production as we look out to the quarters ahead. And we know indices like the S&P 500 are more skewed towards areas like manufacturing than they are to services. And so that would suggest more downside to earnings estimates to me. Combine that with maybe higher labor costs, which we know there's a lagging effect of that affecting this, and just the overall slowdown in demand, I think sets me to believe that we're likely to see downward revisions to earnings. I don't know if this is a typical recession where you get a big, double-digit haircuts to earnings growth. I think it's a little bit different, but we can expect to see at least some declines here. I think most estimates by analysts are still pointing to earnings growth in the quarters ahead. I think modest declines, maybe Q1 and Q2 next year, more likely.
And Jeffrey, we're obviously on the eve of midterm elections here in the US. When you pair sort of the expectations that the markets have versus what we tend to get in the third year of a presidency, how much do you think is correctly priced in at the moment, and what's your outlook?
Wow. I think the election, maybe this year, whenever we look at seasonals and these kind of patterns, they sort of assume a normal year, and this is anything but. I think the main takeaways from this election are probably more at the sector and industry level than at the overall market level. I think maybe the risk is maybe setting us up for a clash over the debt ceiling in early 2023. The market yet hasn't quite sniffed that out, but I think that could be a threat to the market. It could be one of the worst debt showdowns we've had in some time, but that's still some time from now. Right now, I think as we get past the election, maybe past this latest CPI print, and we can reflect back on the fact that central banks may continue to ease, I think that probably sets us up for at least a more positive move towards the year end than much of what we've seen so far.
So, Jeffrey, taking that all into account and thinking about where we are today with the S&P just around 3,800, where do you see us by year end?
We don't put out a price target, but I do think that there may be a bias here to the upside as we see central banks begin to slow. I'm a little concerned again about some of the problems with downward revisions as we look out to next year. So we could be due for maybe another dip. I think this is part of a bottoming process, but maybe over the next 6 weeks or so, maybe the market has a little bit more of an upside bias.
So, Jeffrey, for retail investors watching this story, how would you advise them, given what you also see from institutional investors and how they're moving sort of in preparation for a potential recession or some of these declines that we're expecting with earnings coming up in the future quarters?
A couple of ideas we've been focused on all year are tied to quality, focusing on quality stocks. And what do we mean by that? Well, one way to define it is high dividend paying stocks, those that pay a dividend in excess of the market, let's say 4, 5, even 6% yields. These stocks have been outperforming all year, and they even did so during the October rally, which is really saying something about the power of these companies and investors' focus on quality right now. So not only do they always outperform in recessionary bear markets, or at least have historically, they seem well positioned to outperform in the early stages of recovery as well. So that's one thing to focus on. That's true across sectors and countries. We're seeing that outperformance. The second is what I call short duration stocks. These are companies that have more of their cash flows in the near term rather than way out in future years. We can define that in terms of a low price to cash flow ratio. Again, those stocks have been outperforming all this year. You can find them across sectors, and they continue to do quite well. So those are two themes. I think you don't need to worry too much about sectors or different countries. You can apply this really across your portfolio, and I think that should continue to lead to outperformance in the last couple months of the year.
I know people looking for some good news here, so appreciate you bringing some there for us. Jeffrey Kleintop, Charles Schwab, Chief Global Investment Strategist, thank you for joining us this afternoon.